Welcome to the Seattle Investors Club podcast with Julie Clark and Joe Bauer, where we share the nuts and bolts of real estate investing from our 20-plus years in the industry. Sit back, relax, listen, and immediately take action. Are you ready? Here we go.
Welcome to the Nuts and Bolts of Real Estate Investing podcast. My name is Joe Bauer, and I'm here with my co-host, Julie Clark. Julie, how you doing?
I'm all good in the hood, Joseph. Sitting here in the beautiful Seattle area, getting ready this afternoon to go camping because I want to be like you. So,
where are you guys going camping?
We are going up to Salmon Lasac.
Oh, I love it up there.
Yeah, good spot. You know, just my friends have a spot on the side of the road on the river, not in a campground or anything. That we usually have one of the guys go up early and grab it. So he went up yesterday and got it, and all us girls are following behind today. So that's what I'm up to. What are you up to?
I'm just hanging out in Anchorage, Alaska. We've been doing a lot of flying in and out of places, which has been amazing. I don't know if anybody's been following the pictures along, but the bush planes and the places that they've been able to fly us into have been so cool.
Oh my God. I have been seeing that. Are you surprised by how beautiful Alaska is? I mean, is it like unexpectedly like, holy cow?
You nailed it. So like, I wasn't really super stoked about Alaska when we started. I wasn't sure what to expect really. And it has surpassed my expectations like tenfold. It is so pretty. It's so big. The people are nice. They're kind of like more relaxed up here, it feels like.
Yeah. Well, what about all the bears and stuff like that? It looks like you're getting face to face.
Yeah, there's a lot of bears. We haven't had any face-to-face encounters where we're like not in a protected area, although I guess, 50 yards or so away is about the closest that we've been. We had a really close encounter with a moose. We're like running down a trail and there was this huge bull moose, 10 feet away from us that just happened to step up onto the trail.
Wow.
So that's pretty normal. And there was actually a moose in the neighborhood that we were staying at right now, like just down the street. And I was talking with the neighbor kids and I was like, did you see the big bull moose? And they're like, yeah.
Yeah. Like he's here all the time, right?
Yeah, no big deal.
If you guys are not following along and you love traveling, you need to make sure you're following Joe on all his social media stuff. Where can they find that, Joe?
The Fantastic Life on all of our channels, wherever you want to follow us. And we're trying to get the blog caught up. So there's some longer form stuff if people like to read on thefantasticlife.com.
Yes, but if you're depressed at all, people, don't look at it until you're in a good mood, because you'll feel like, dang it, I'm sitting here doing nothing or working my butt off, and Joe is living the good life. So we're going to jump into it because today our guest has figured out, very smart, and figured out how to live the good life himself. Today we have with us Rich Carey, and Rich is the founder of RichOnMoney.com. He is a father of two and self-proclaimed finance nerd. And you know how I like those finance nerds. And what makes Rich unique, you guys, are two things. First, his view of money, investing in real estate is not in line with mainstream thinking. Again, what we want to hear from. Second, he's built his debt-free real estate portfolio while living overseas and serving in the United States Air Force. Still in the Air Force today. I think Rich has, he said, maybe one more year to go. And just using his military income, he's been able to pursue his real estate investing, been able to pay off all his student loans, pay off his own mortgage, flip several houses, buy 20 rental properties that are debt-free. So he's got a great message today. He's got going to teach us some things, maybe a different way of thinking. And I think you're all going to enjoy hearing Rich's story and maybe get a different perspective on how to approach real estate investing that you don't hear as often as we maybe need to hear. So thanks for joining us today, Rich. And also thank you for your service. I don't know if you're in the military, do people like it when people say thank you for your service, or has that become like this canned thing?
So can you guys hear me? Hello, everybody.
Yeah, we can hear you.
Yeah.
Awesome. It's something that we definitely like hearing. It's kind of weird. It kind of depends like where I go in the United States, but in some places I go, people say that to me all the time. A good example of that would be, I'm in Alabama right now, Montgomery, Alabama. And people say that all the time. And then like other places I go, people hardly ever say that. So it's kind of interesting, actually.
I always wonder if, the military guys and gals only like to hear it in certain situations, or to make sure it's sincere and not just overly used,
I enjoy hearing it. Yeah, I enjoy hearing it.
Yeah, great. Well, thanks again. So let's kick it off. We're going to kick it off. Joe normally has a question to get us going here, and then we'll just see where this goes.
Cool. So, Rich, we love to hear about how people got started. And what I mean by that is basically how you grew up and where you grew up and how that made you or molded you into the person that you are today, and then how that got you into real estate.
Okay. So I grew up in Southern California. I grew up in the Los Angeles area, so kind of by the beach, and kind of grew up in, I'd say, like middle class family, Anaheim, so sort of near Disneyland. And kind of what got me interested in real estate, I sort of had real estate on both sides of my family, and I'll sort of explain what I mean by that. My father's father, so my grandfather on my father's side, he was a general superintendent, and that sort of meant that he was in charge, his job, he was in charge of large construction projects. Like when real estate was booming in California, I guess it's almost always booming, but when it was booming like in the sort of early 80s, he was in charge of these large construction projects where they were building, 200 or 300 tract homes in different parts of Southern California. And I remember being like 5, 6, 7 years old and just driving around these huge jobs with him and watching him kind of like, kind of making these decisions about, oh, hey, you need to change that or do this. And I kind of thought that was really cool that he was involved in building these large, projects of homes. And these are just kind of like, average homes, homes that maybe now would probably, I guess now in California are probably selling for $600,000 or $700,000, but probably the typical middle class 3-bedroom and 4-bedroom, 1-bath homes. And then on my mother's side, my mother's mother had a very interesting story with real estate when she was growing up in Los Angeles. And she grew up in a very poor part of Los Angeles called Watts, which maybe some of you have heard of. If you haven't heard of Watts, you've probably heard of Compton, and that's kind of the area where she grew up. But she grew up in an area, and when she was kind of young in her sort of early marriage, her husband left her, so she ended up raising 4 children, including my mother, on her own. And somebody in her family, like an aunt, suggested to her that she buy a 4-plex and live in one of those properties and rent out the other 3. But like at the time, for a woman to do this, this is like the 40s or the 50s. For a single woman to do this, I believe was very unusual at that time. And there were a lot of other people in her family and among her friends and coworkers that told her that she couldn't do it and that it was crazy. But she did do it. She did buy a 4-plex and live in one of them and rent the other 3 out. And that 4-plex ended up being like the pillar of her financial freedom for pretty much her whole life, all the way up to this present day. And I always admired her for doing that.
That is awesome. Good story. Good story. So you witnessed all that.
Yeah.
And then what happened? You grew up and you're like, I want to be like my grandma.
So yeah, I mean, I always loved, I remember thinking when I was, 10, 12 years old, living in Southern California, I remember thinking to myself, gosh, I wish I could buy a house right now, because I bet you by the time I was 18, it'd be worth a ton more. I mean, that's probably a strange thought for a 12-year-old to have, but like, that's just what was running around in my head when I was a kid. I just always had this love for real estate. I ended up going into the military, ended up going to Guam, which is not that many people know where Guam is, but it's like some island out in the middle of nowhere, much more remote than where Hawaii is, but it's actually a U.S. territory. Guam was one of my first assignments, and it was not a good place to buy real estate. There was a lot of earthquakes and typhoons there. So I couldn't really buy real estate at that point of my career. Once I got back from Guam and ended up in Washington, D.C., that was pretty much at the third year of my real estate career, and that was 2003. Me and my wife were finally able to buy something. So we bought a townhouse for about $280,000, which I thought was way too much money, and I thought was going to be the worst decision of my life. So that was our first venture into real estate.
Awesome. And that has launched you into, that's where you started learning about what numbers work and what numbers don't. So keep going, keep telling us where you've got us on pins and needles here.
All right, I can keep going. So
keep going.
When I bought this house for $280,000, I thought it was the worst mistake of my life because I knew the market was skyrocketing. I think the person I bought it from had bought it for $180 like 2 years ago. And so I believe I'd overpaid, and I didn't sleep for a few weeks. And lo and behold, about a year later, it was worth $400,000. So at that point, I had realized that I was a financial genius and that I was just going to keep doing this every year for the rest of my life and be a multi-millionaire in a few years. At the time, I thought that was, the way life worked, but it turns out things aren't that simple either. You don't buy a house and it doesn't shoot up by 50% every single year. But actually, sometimes it's unfortunate when you see that much success the first year you buy something, because it gives you an unrealistic expectation of what your future success is going to look like.
Absolutely.
Right. So once I bought this, and I think I see that problem a lot, with investors now, when people do things like this, when they buy in Hawaii, when they buy in Southern California or San Francisco or DC, and they see a lot of appreciation, and they tell their friends, like, this is easy, you've got to do this. I think you got to think twice, because that appreciation doesn't happen every year. It happens in spurts. And I'd say that for Seattle too. It happens in spurts. And then there's these like long periods maybe where no appreciation happens. And I'll give you a good example about this townhouse that I bought for $280,000. So actually it ended up shooting up to about $450,000 eventually, maybe about 3 years later. So I thought I was the best investor in the world. But I eventually sold that townhouse. I moved away, and I ended up, moving every 1 to 3 years over the next 19 years, right? I moved somewhere. I moved all over the world. So I owned that house for 16 years and then 13 more years, and eventually sold it in 2016. But how much did I sell that house for 13 years later? Well, I sold it for $400,000, and this is DC. So it really never appreciated anything beyond what it made a year after I bought it.
Right.
And if you do the math, it made about 3.5% appreciation over the 13 years that I owned it in a major metropolitan market. So I learned a valuable lesson about appreciation that I think I'd like to tell your audience there in Seattle, if that's your major audience.
Yeah.
And that is like, don't get on this like, oh my God, we're all going to be rich train, where it's like, all we got to do is buy in Seattle and we're all going to be rich forever. I think that sometimes you can get lucky and make a lot of money over a certain period of years. But over a long period of time, all markets, and by the way, this is also true for Hawaii, because I have several investors who have owned long-term in Hawaii. All markets are going to make between 3 and 4% over the long run. And to think that you're going to time the market and do much, much better than that is something that I'm not going to try to do personally.
I agree. We here in Seattle, we definitely have a very close-knit investor community. Everybody is aware that the rental properties in Seattle don't really pencil. So we unfortunately, everybody outside in other markets, I don't know. I haven't heard anybody really talking much about Montgomery, but they're talking about Nashville and
Sure.
some of these other places. There's floods of West Coast investors coming to those markets because they know that's where the cash flow is, right?
Yeah. There's cash flow here, and I could talk. I mean, there's cash flow here, but there isn't really appreciation in a market like Montgomery, and there isn't. I mean, there's other markets nearby here. Birmingham is probably a little more of an appreciation market than Montgomery. It's about an hour and a half away from me, but not much more. I think that Huntsville, which is a few hours away, is probably a city that you hear about a lot more. If you're looking at the booming rental markets, and you're like looking at lists in a magazine or something of something that you might see appreciation coupled with cash flow.
Tell us what I found interesting, your perspective is, I think you have some history as a stockbroker, or you worked maybe did that a little bit as well.
Yeah.
Share with us your beliefs on, for yourself, or your spin on real estate versus the stock market, and how that impacts your own personal real estate investing decisions.
Okay. So, I mean, I guess for me, a lot of people will come to me, and I'm in the military. So when military members hear my story, say like I was on the Bigger Pockets podcast, that's one. There were a lot of times military people will hear me, and then they'll reach out to me, and they'll be like, "Oh my gosh, you're in the military and you made it in real estate. Like, I want to do it too. Like, help me buy real estate, or help me figure this out." Well, a lot of times maybe they're in debt, and maybe they haven't really started investing yet, but they want to make it like big in real estate, right? My feelings about real estate are, I'm going to invest in real estate from a financial position of strength. So, and again, I'm a conservative real estate investor. I want to take care of, first thing I want to do is pay off my debt. And I don't necessarily mean you have to pay off your personal mortgage. I don't necessarily mean you have to pay off really low interest student debt, but I want to pay off all other debt. Next, I want to take advantage of 401k plans. And if you're in the military, like a TSP plan or a Roth IRA, or a traditional IRA, I want to max those things out. And then I think you should probably have some normal investments. You should have something that's in a brokerage account, or something that's in some kind of mutual funds. It shouldn't be zero.
You were talking about, so you're diversified.
Yeah, you should have something in savings and something in some kind of mutual funds. But I believe that having a balance of, I have some stuff in the market, and I've also decided to put some money in, rental properties. But I guess my point is, some people want to I'm in debt, but I want to buy a house. So I've heard there's ways to do it with no money down. Help me do this. That is not my style at all. If you're in debt and you have some financial problems, my advice is get yourself out of debt, and don't do it through trying to find some creative way to finance a multifamily property with other people's money that you might screw up. You just got to get yourself out of debt.
What I that you mentioned on when I was reading more of your stuff is that you talk about the S&P 500, and right. that you measure for yourself, well, geez, if I can invest in the S&P and make 7 or 8%, then my real estate investing needs to do better than that
yes.
before I'm going to make a move. And I found that we all talk about that. Mostly I hear people talking about it as investors. Is that's what they pitch to, people that have money in their retirement accounts or self-directed or, retirement accounts, and they want to borrow private money from them. They give them the talk of, well, you're going to get more money doing this with me than, keeping your money in the stock market. I haven't really seen anybody talk about it where, how you've talked about it on your website, where you mentioned the 7 to 8% is achievable maybe on the S&P 500, versus using the minimum 1% rule on investing in rental properties. And if you can't achieve better than that using the 1% rule or better, you might as well just leave your money in the S&P 500. Do you still live by that then today, or?
I think I absolutely live by that. Well, I mean, I'd say I absolutely live by that, but I guess I'd put a caveat on that, and that is, obviously you can diversify. I mean, the market might do one thing, and long-term rental properties could do another. But that is a good. I've always thought that was an excellent way to look at your money, and that is, I'm not going to bother with a real estate investment. A real estate investment is a lot of work. A real estate investment, you've got to mess around with, you've got to mess around with all these different people, contractors, real estate agents. You've got to deal with tenants. You've got to work with, there might be, whether it's property managers or you're going to try to manage yourself, you've got to do taxes. There's like tons of people that will all take cuts of your money before at the end of the day, maybe you make 5 or 6%, maybe. And I think that's very, very hard. I mean, my properties are paid off. That's I think it's very, very hard to do with debt. It's very hard to do with debt. Especially,
what do you think about like syndications where, you are passive and maybe it's self-storage or something, and you're, with vetted syndicators, maybe that you have relationships where their business model very well, and you have a level of trust that they're offering maybe 8%, which seems very reasonable, and conservative, with the upside, as you say, don't count on the appreciation or the equity as a bonus. But as opposed to, if I can get 8% investing passively with somebody that I trust on that sort of thing, and then I'm not dealing with any property managers or turnover of tenants or delinquent rents, and I can pay somebody to do that, but then I've got to deal with the property manager that might be a pain in my ass and things like that. What do you think about that sort of syndication investing in maybe other asset classes to diversify beyond single family rentals, right? It's a pizza pie, right? Like you say, have some, me the same. I have some in the market. I have some in multifamily. I have some that I actually have cash, like reserves, and I have all that stuff. But I also invest in syndications because it's no work with good returns. If I can find somebody I trust, which I've spent good amount of time vetting myself.
Right.
What do you think about that?
I've tried so hard to find something other than the S&P 500, and then like my own model of single family properties. I'd say that maybe my stuff's doing better than 7%. My stuff's maybe doing like 10% or better. I've tried so hard. I understand your question. I like that 8% to me that you're talking about in a syndication. To me, for one thing, it isn't guaranteed enough for me to be comfortable with. For another thing, I don't know if the right word is greedy, but I'm very careful about fees. Like with index funds, S&P 500 from like Charles Schwab, I know that it's like a 0.04% fee that they're taking. With a syndication, I know that the people that run the syndication are making pretty extensive fees, right, for running that syndication. And you could argue that maybe they deserve it based on the work they're doing.
Well,
I'm just not a fan. I'm not a fan of that. Yeah, I'm not a fan of that.
The fees and the equity stuff pains me to think about those types of things. But I'm looking at a trade-off. Like, I'm saying do some of everything. I'm just talking about here, in regards to that. Do you find, as far as your rental properties go, we can get into some other stuff about some cool stuff you have on your website and things like that to help people understand very clearly and simply how to calculate those returns. But one thing nobody ever talks about on the rentals that I don't really hear many people talk about is delinquency. People
Right.
who don't pay their rent, or, then you have to evict them. And, do you feel that, the 50%, you're using those rules, right? The 1% and we'll say 50% for expenses. I get a lot of calls from investors who pursue this model. I'm saying go for it. You need to do some of everything. I'm not saying not do
Right.
it. They get beat up by the fact that they have huge turnover or more so delinquency, and then have to evict them, and that takes time, and time is money. And now you've underwritten your deal for your vacancy, but maybe if they're not paying rent, and then you have to go pay for eviction, and on top take the time to evict them. How do you deal with that, or what are your tips on that?
Yeah. Well, so I could tell you one thing, and that is that when I first started in Montgomery, Alabama, I was very concerned that those types of things could potentially, I didn't know if they were going to like totally bankrupt me or if they were just going to eat badly into my returns. So I have 20 properties and I've had them for about 6 years. I've had a lot less evictions than I thought I would. And in fact, I think maybe it's about 3. And also, and I have a pretty high turnover. And we can talk about that too, and how that's built into my property management fees. But and one of those evictions is 100% my fault, because the first time that the eviction happened, it was a decision that was put totally in my hands, where all the warning signs were there. The management company came to me and said, "We're not so sure about this person. There's definitely some warning signs, but she seems like a really good person, and she has like this hard luck story. It's sort of up to you. Like, do you want to just
came at you with an emotional approach?
Yeah, like do you want to just like be a good person and help them out? We think it'll turn out okay. But I mean, lesson learned. If it's a business, if you hear it, if you have like criteria and the person doesn't meet the criteria, then don't let them live there.
I say this also because I think I read, which we have several friends and fellow investors here in the Seattle area. Like I said, there is a big contingent of people looking to invest out of state and that are already investing out of state for exactly the reasons that you discuss and outline, on your website and things like that, and that you teach, because everybody should be just focusing on cash flow, right?
Yeah.
But as you mentioned, you live in Montgomery, but the neighborhood you want to live in versus the neighborhood that pencils for you to buy these investments, it might be a comfortable neighborhood for you to live in, right?
Yes.
And so, for me, myself, I'm just, all I do is, try and learn things for myself and share it with my friends here, is that actually stops me from wanting to do those investments. I think it's just because I'm lazy, maybe, or I'm nervous or, concerned that I'm going to be dealing with, a constant pain in the butt on the tenants. And like you said, maybe there's alternative investments that, it's to each person their own, right? How much effort do you want to make? Some people want to do these things just because they want to go through the learning process as well, right? Yes, pursuing the cash flow, but you also want to learn through the process. But I mentioned the turnover and the delinquency and things like that, because maybe to achieve these cash flow properties, people might have to invest. I don't know. They might have to invest in neighborhoods that are a little rougher. Is that a factor? Is that sometimes a factor? Or it just depends. What do you think?
I guess I could say that there are like varying degrees of this. And I think that Montgomery is a very good example of this. The areas that I invest are like these are when somebody moves into one of my properties, most commonly I have 3-bedroom, 2-bath, and 4-bedroom, 2-bath. And I think the rental price here, if you rent one of my properties, I'd say like $950 or $1,000. When you move into one of my properties, the lawn is cut, everything looks nice outside. It looks everything looks, and when you go into the house, the carpets are new, the house is freshly painted, like everything looks really, really nice. And most houses in the neighborhood are also like that. Now it's the schools in the area, and this is just the way Montgomery is. The schools in the area are not that good. And there is some crime in those neighborhoods. There's not a lot of crime, but there is some crime in those neighborhoods. So I guess you could say it's lower to middle class. It is not like the kind of place that you're scared to live. It is not the kind of place that it's scary to drive around. But at the same time, it is not the kind of place. I mean, there are Starbucks, and there's just I don't know, it's just kind of a normal neighborhood. But they're not the places where, if you're the kind of person that understands, when you go to a city and you seek out the neighborhoods that have the best schools, like the 10-10 schools.
Yep.
It's not those neighborhoods. And there's not gated communities, and there's not golf courses.
Yeah.
So I've chosen.
This is chosen.
Yeah,
Do you
I've
think there's
chosen.
some sense in if you're researching where to invest across the country, you
Right.
almost could. This is me being a dork. This is just how I think. You could reverse engineer that into looking for school districts that are middle of the road or lower middle.
Yeah, I guess what and this is you brought up a very good point. I think this is worth explaining. When I got to Montgomery, and there's a lot of people that do what you're talking about, like people in the military like me. They buy the house that they move into, and then when they leave, they rent it out. But it doesn't pencil well. It ends up being a very poor investment. And a lot of people that rent these houses out, they only want to rent them for 10 months because the people that come here to live in the military, they only need to live here for 10 months because they just come here for a school year. And so it actually ends up being a pretty poor rental property. And of course, the 1% rule, which we can get to if that's something you want to talk about, it's a bad rental. It has a poor ROI. But you move down to the $1,000 rentals, which is where I'm at, and you've got a pretty good ROI. But at the same time, you move into a little bit worse neighborhoods or a lot worse neighborhoods, you can buy houses for $10,000 or $15,000, and you can rent them out for $60,000, and for $600 a month, and you can have a really, really good cash flow. But those are actually those are meth labs, right? And those are people getting shot all the time. And there are really, really bad neighborhoods in certain parts of Montgomery where you can buy houses for $10,000 or $15,000. You'll never be able to sell them. And you will have horrible problems with your tenants. But, and these are, by the way, that if you've heard of turnkey companies that are shady, these are the turnkey companies that are shady. But those are also here in Montgomery. And so being able to understand an area well enough to figure out exactly what sort of range you need to buy in is not an easy thing to do. And that's why it is not exactly easy to just live in another country or state and just decide I'm going to start buying houses there without having some local knowledge.
Right. Are you a real estate agent by any chance?
I'm not. No, I'm not.
Have you ever thought about getting a real estate license?
I have not. No, I don't think I'll need to. I think that I'm always okay working with a real estate agent that's very experienced working with investors.
And you're good to go because you have 20, free and clear properties, right? So you can start enjoying your life. Yeah, well, that's, I agree. I mean, there is a lot of interest and a lot of people investing out of state. We have some good, I would say, people that are helping our local crowds invest out of state that are, of the same mind frame as you in some senses. But do you have properties in other states or other places outside of Montgomery?
I don't, but if you don't mind, I'd like to speak a second to how I used my property management company while I was investing from out of
Sure.
country.
Absolutely.
Because I think it's key to the discussion that we were into earlier, and what you were asking me about as far as how did you decide on buying in this particular range, right? Whatever it was, like I'm buying in this. What ended up being houses that rent for about $900 to $1,000 now. At the time I bought them, they were renting for about $750, so they've appreciated a little bit. But one of the things that I was doing while I was overseas, I mean, I could have been out of state, but in my case, I happened to be out of country. But one of the things that I was doing was I was finding these houses on the MLS, or I was finding them through other methods. I was also doing mailers. But however I was finding them, I was making lowball offers on them through a real estate agent. Just lots and lots of lowball offers. And whenever I got a lowball offer accepted, I would have my real estate agent go over and look at it. And if she thought that it was going to be a possibility and she sent me pictures, then I would have my property management company go over and look at it and also take pictures. This is very important because the property management company owns lots of houses in the neighborhoods that I already own in. And they understand what neighborhoods are bad, and even what streets are bad. And sometimes one street can be great and the next street can be bad. Sometimes you've got the government mansion on one street and you've got the projects on the next street. And that can really affect like property values. It can affect crime. It can affect desirability. It can affect a lot of things. So sometimes I would even have an accepted offer on a property that my deposit had already been accepted on, and my property manager would go look at it. And sometimes they'd say, this is a horrible location. Or sometimes they would say, this floor plan, like renters hate this floor plan. Or like there's this thing with the stairs, like we walk up the stairs and you keep hitting your head. There'd be something weird, and I'd back out of a deal and lose my deposit. Just because a property manager would tell me like, this just isn't going to work. So that's a way that I'd use my property manager, because I'm not there, and because they've got knowledge that I don't have anyway, because they're the ones that have to rent it out. And they're the ones that understand the specifics of the neighborhod of the neighborhoods that I've decided to try to have my rentals in. Don't know if that's helpful.
It's helpful. I think, like I said, we have some people that are currently investing that realizing how important it is for the property manager to be part of that process. I think let's dive a little bit deeper. Do you have any tips on finding good property managers? What is, and it sounds like you may have, did you somehow tie evictions or turnover into your property management agreement?
Yeah, I think in my particular case, so I think that I wrote a blog post on this, and I think maybe you guys could link to it, but it's just about like how to find a good property management company. And I kind of, go down a list of all the different things you should do. In my particular case, I always kind of worried that evictions would be really expensive. I haven't done that many evictions, but in my particular case, it just wasn't expensive at my property management company. It has to do with the laws in the state, and it has to do with the fact that one of the people on the team at the property management company also is an attorney, and they do the evictions themselves. So, and they kind of think it's fun, So it just isn't very expensive at our property management company. And that's one of the things I checked before I signed on with them.
Nice. That's a good tip, right? That's a good tip. I know of a local property management company here that is owned by an attorney as well, or has an attorney on the team, but nobody wants to buy here. That's a good tip. Any other tips on hiring good property managers? Joe, we'll go ahead and grab that, his post on that as well, and put it in the show notes here. But anything else that top 3 things that you would look for?
I'll tell you the most important thing. There was one thing that was probably the most important thing for me while I was gone. This may not apply to everybody, but it applied to me because I bought 6 properties while I was here in Montgomery, Alabama, and then I bought 14 more while I was gone. And so what I needed was somebody to supervise large, basically large make-readies or large construction projects on the property I was buying while I was out of country. And for me, that ended up being my property management company. Now, other people may figure out that it could end up being somebody else, but for me, it was my property management company. And they just kind of set up a deal where they found the contractors and I paid cost, plus 10% markup. And that was something that worked for us.
And they've added them. Are your property managers tied to any, problems that happen, or, do they have any incentive if things go well, because that's, I think, probably the biggest challenge people have, other than, finding.
Well, I mean, I guess I'm a relatively large customer for them. And I think that they're sort of invested in wanting me to have a larger portfolio, and then I'm a long-term customer for them. I think that what I noticed about working with them when I was here locally, I guess the point is, when I was here locally with them, they always called me about really small things and would talk to me about it and say, like, we were gonna replace this, like, we're going to get you this like new washer, but like we could get you a used one and it'd be like $100 cheaper. Or, there was this problem with this like thing, but we could do this instead and you'd save like $10. And basically what I realized was they were really looking out for me when it came to cost over like really small things. And so I guess I kind of realized, like, this is like a property management company that I can trust. And how often are you going to come by that? Like maybe almost never. So I realized that I'd struck gold with these people, and they charge 10%, which I think is actually kind of high. And especially as you go up in properties, you probably could ask them to drop down that 10%. But here's another thing that's key for me. My properties, just because of I think maybe the neighborhoods that I'm in and just the nature of the area that we're in, kind of high turnover, but they don't charge for turnover. They don't charge for writing a new lease, and they don't charge for they don't charge for bringing in somebody new once somebody moves out, and they don't charge for rewriting a lease. That's built into the 10%. And I'll tell you, that is really important, because a lot of companies charge either 50% of a month's rent or an entire month's rent.
That is that is a good tip right there. People get so focused. Investors, I find, are such cheapos, which is good and bad, that they focus like on every little dime of this or that. They might miss the bigger picture, so what I'm hearing out of that is, like just like you said, maybe 10% is not the cheapest, but it includes some of the costs that can make it extremely expensive for me if it was more like 8% and I was having to pay half a month's rent for, leasing or whatever else. That's a good tip. And, and that's actually a good negotiating thing for all you guys that are listening, is to ask that. Maybe you'll surprise somebody when they say, hey, I'll pay you 10% instead of the 8% you offered me, but I want it to include these things. It's all negotiable.
Yep.
That's actually, I think, the nugget of the day so far.
Cool.
So that's a good one. There you go, guys. That's a good tip right there. We appreciate. So let's move on, and we're going to wrap up pretty soon here. But now I want to talk about, you don't use debt. You prefer to use cash for everything.
That's interesting. It's weird. It's not so much that I prefer to. It's just that I ended up not using debt. I know that might sound strange, but the houses were so cheap, and I had the money because I'd been, saving and investing well. And it's actually kind of hard to get a loan for my first house was $25,000. It's really hard to get a loan for $25,000.
Right.
Actually just like tried. I just tried like at 2 or 3 banks, and I couldn't. And I'm just like, well, I have the money. I'll just pay cash. And then I'm just like,
you do it as a portfolio and do a bunch together. I mean, I certainly know somebody that you can talk to.
You can, but I just, again, I'm very fee averse, and I'm like, well, if I have the cash, why am I paying all these extra fees? And I just decided not to. But like, in the future, I'm actually just sort of a thing that I want to do. I want to own multifamily because I want to have that sort of next step in my real estate resume. I want that experience. I want that. I want to learn it, and I'm going to use debt to do it. And it's not. I don't have like a religious problem with debt. I just didn't need it. I just didn't need it. And
Right.
there's an amazing peace of mind with not having it. But I guess it's nice not to use debt. I didn't need it, but I don't go around preaching it.
Well, let's talk about this. So I think one of the things I liked about that you had stated on your website was it's smart to evaluate each investment opportunity as if it were a cash deal.
Yeah.
That way you can separate the quality of the house investment from the quality of the loan you are getting, which are two very different things. That point right there, breaking it down like that is very helpful to point out to people. I have a note here asking to explain, to the listeners here, the difference between cap rate and ROI, as far as one's with a mortgage and maybe one's not, right?
Well, I think what you said, what you brought up earlier, though, I think is pretty important about, it's not so much that there's an important difference between, like, I think I just lost my train of thought.
Well, we're talking about, evaluating the properties as if you were going to buy them with cash, whether you're using debt or not, versus, separating the way you look at them. I said, because that way you can separate the quality of the house investment itself from the quality of the loan you're getting.
Yeah. And I guess I wanted to say it's more that it's dangerous, right? It's dangerous to use creative financing and then it's kind of like, see, I can make this deal work, right? I can make this deal work because I've done all these creative things and I can get into this with no money. And so so I should do this deal. But yeah, you should be looking at it. You should be looking at it from a cash perspective and see what the house's, return on investment is actually going to be. Make
sure as a cash deal, it meets everybody has different rules and, for themselves on investing. So you're saying, make sure you look at it as a cash deal that meets all your rules. And then if you want to do something with creativity or debt or whatever you want to do on top of that, do that, but make sure that's the benchmark that you're evaluating from.
Absolutely. Yes, absolutely. Yep. And I think that when you do something with a loan or something, with creative financing, that's an extra expense. That's going to take some kind of expense of some kind, and you can figure that out separately. But first and foremost, as a cash deal, how does this rate? Then after that, what are your criteria for financing? That's a totally separate thing to figure out after. How does this look as a cash deal? That's the way I look at real estate.
And in addition to that, where are you in your life personally? You know what I mean? For yourself, everybody needs to evaluate. What does my job look like? Do I have a job? Am I keeping my job? Am I retiring in a year? What's the forecast on the housing market? All those things come into play that are different for everybody. So you can't go learn. Somebody can't tell you what to do because nobody knows your personal situation, right? And a big part of deciding what to do with your debt or no debt or what you're doing is related to everybody's own personal situation. So everybody needs to keep that in mind. It's not just, here's a property, let me crank the numbers. You need to also incorporate in there, this is where I am in my life and this is what I'll need in my life. And I'm going to hold this property for so long I am or I'm not. Because, these things are probably projected to happen to me or I want them to happen to me in the next few years and, or my husband's going to retire or whatever, all impacts the decision, not just like this snapshot in time.
Right. Yes. Mm-hmm.
Good stuff there. Well, good stuff. We, I want to tell you guys what we didn't jump into today was talking about how to underwrite, single family rental investment properties and the 1% rule and things like that. But what I can tell you that you're going to be excited about is that you can actually just go to Rich's website, and you will find that information spelled out very, very concisely and very clearly. And we will go ahead and put a link to that in the show notes, as well as a link to, you had a post that was how much money will I make from my rental. That was very clear, very helpful to people. And you guys should all go look at it, whether you think you know what you're talking about or not. It's always good to look. I would look over everything that he's talking about, because his perspective is fresh and conservative and smart. And we appreciate having him with us on the podcast today. So last question for you, Rich. Is there any podcasts or blogs or anything that you listen to or read or follow that you're a thoughtful guy? So we want to know, everybody needs to continue to educate themselves all the time. And a big part of that is by taking massive action, but we also can learn from others. So anybody that you would recommend, any other podcasts?
I'll tell you, this isn't necessarily a podcast. It's my favorite book, right? And it's called Fooled by Randomness. If either of you heard of this?
No.
Nope.
Fooled by Randomness. It's by Nassim Taleb. And it is a book about how randomness is sort of misunderstood and underestimated in its roles in our lives. And it really helps people, I think, understand the stock market, maybe mutual funds, maybe money, and maybe financial advisors and economics a lot better. And I think it's actually a very helpful book. So it's something that I'd love to recommend.
Excellent. We haven't heard of that one, so we'll throw that into the show notes as well. We're going to wrap it up here now. Is there anything else you want to add? You guys, we want you to go to RichOnMoney.com, and you're going to find all kinds of great information and a little bit more about Rich himself. And you find a photo of him there as well, and what he's up to in his life. And we want to keep up with you and maybe have you on, if you end up going on to buy some multifamily properties, let us know. We want to hear how that goes for you. That'd be a great follow-up maybe that we can do with you.
Awesome.
Start moving that direction. What do you find, last thing that might be helpful? There's always positiveness, you got your 20 paid off rentals and no debt and all this stuff. What's the toughest part about, everybody's got some tough parts. Do you have anything?
Yeah.
What's the tough part right now, if any?
I think the tough part is there's always this nagging feeling of like, how much money would I be making had I used leverage this entire time? What if I controlled 80 or 100 properties and I'd used leverage? Like, would I have double or 4 times or like 8 times the cash flow? And sometimes I had that nagging feeling, but at the same time, I kind of realized, well, that's not fair though. Like, what if there had been a huge crash in the market, right? I would have been protected from like this big crash. It didn't happen, but I would have been protected. So I should stop second guessing myself. But
Right.
that nag is sometimes there. Like, why didn't I, take advantage of, I could have used more leverage, that nag
maybe you still can, right? But I agree. I'm at this stage in my life, I am very focused on trusting my gut and my comfort, right? So it's to each of everybody. If you're feeling more comfortable the way you're at and the nagging is less than the comfort, then there you go, right?
Yeah.
You'll sort it out. Well, good stuff today, guys. Little admin here at the end. I'm going to remind you guys that you should come out. If you have not joined our weekly mastermind yet, not only do we have 1, but now we have 3, soon to be 5 locations for our Seattle Investors Club weekly masterminds that are small group, we'll call them coaching and mastermind events. Maybe there's 10, 15, 20 people there, a really nice size where we sit face to face, have some lunch, and everybody brings any questions they have, their problems, their deals. It is a very powerful venue when you are able to sit face to face and create relationships and go deep with people. You have 10 people sitting there trying to help you solve a problem that you have. You have deals flowing back and forth, all kinds of stuff going on. You owe it to yourself to come at least once to check it out, and I think you're going to be pleasantly surprised. It's a fresh perspective on networking that I think you guys will find is might become one of your favorite venues if you give it a try. So come join us on Tuesdays in Burien from 12 p.m. to 2 p.m. at Angelo's. You can find that information on Meetup. And I'm here to also tell you that starting September 5th, we are going to have a weekly meetup every Thursday from 10 a.m. to 12 p.m. at the Family Pancake House there in Redmond. That's out kind of where 520 ends. And we also have a Skagit County meetup that happens twice a month now. You can find it on meetup.com or shoot me an email at julie@seattleinvestorsclub.com if you want to know more about that. But it's hosted in Mount Vernon. I believe it's 10:30 to 12:30 at the Calico Cupboard in Mount Vernon, twice a month for that. Not every week, but twice a month on that one. So I think you owe it to yourself to give it a try, and we will sure be happy to see you there. Other than that, Joe, hit them up with the details.
Yeah, guys, you can find all the show notes, including the links that we talked about today, to Rich's blog posts at seattleinvestorsclub.com/85. That's seattleinvestorsclub.com/85. And if you like this show, make sure that you give us a review on iTunes. We'd love to have you do that, and make sure you subscribe while you're over there.
Right on, right on. Well, Rich, have fun in Montgomery. Joe, have fun on the road. And I'm going to go get some camping on.
All right. You have fun.
Thanks,
right.
everybody. Thanks for the opportunity. It was a good time.
Let's stay in touch, Rich. Thank you so much.
Thanks.
All right. Bye-bye.
Thanks for listening to the Seattle Investors Club podcast. If you have questions that you'd like to have answered on the show, shoot us an email at info@seattleinvestorsclub.com. Now go out, take that action, and build that real estate business. Thanks for listening.